Secretary Yellen, thank you so much for joining us here today at Reuters Next. Let's jump right in, and let's jump right in with the dilemma of the moment, inflation. Now, there's no question that inflation is worrying us all in a way that it hasn't been for a long time. Policymakers, including you, have maintained that it is a question of reopening bottlenecks that were expected to be short-lived. Your successor at the Fed, Jerome Powell, just this week, as he was seated next to you, in fact, said that the word transitory is no longer an apt description for what is going on. US workers are resigning in droves, and wages are rising at a pace that we perhaps haven't seen in a generation. So, can this really be dismissed as a shock that will soon pass?
Well, I wouldn't. I'm ready to retire the word transitory. I can agree that that hasn't been an apt description of what we're dealing with. I think the pandemic has contributed in very important ways to the inflation problem that we're facing. But the pandemic too, although over the summer, it really looked promising, as though with increased vaccinations and booster shots, life was returning toward normal. Now the new variant, the Omicron variant, the pandemic could be with us for quite some time, and hopefully not completely stifling economic activity, but affecting our behavior in ways that contribute to inflation. So let me just say, to my mind, inflation is a phenomenon that's affecting almost all developed countries. That suggests there is some common factor. I think that common factor is the pandemic. Inflation's a matter of demand and supply. And in the United States, we did boost demand by passing a series of strong fiscal actions, starting with the CARES Act, the American Rescue Plan. Our motivation for doing that was that we wanted to avoid the kind of experience we had after the 2008 financial crisis, where it took a decade to get back to full employment. In the process, many people were scarred both by the financial impacts that they suffered and also by long-term joblessness that can have a permanent scarring effect. So, this was a pandemic that particularly affected the most vulnerable of our citizens, the ones who could least afford financially to get through this. And, with unemployment skyrocketing to almost 15%, there were early periods in which you would see cars lined up in parking lots in the United States, people getting food because they were endangered putting food on the table. We put in place a large fiscal package to address those needs, particularly of those most vulnerable. And we've enjoyed a very strong recovery. It supported demand. It helped the most vulnerable. The United States has the fastest recovery. Did that contribute to inflation? Yes, somewhat. But because we did support demand, and demand is very strong. But the pandemic added factors on top of that have really caused inflation to become, at least for the time being, a problem. So one factor is that the pandemic just massively shifted patterns of demand away from services and toward goods. And it also dramatically increased the demand for technology and technology-related digital services. And both the products, everything has semiconductors in it these days, and the switch to this intense digitalization we've been left with semiconductor shortages that are a contributor to inflation. In the United States, I think the largest price increases we're seeing are in new and used cars. Automobile factories have had to curtail production because they can't get the semiconductors they need. And people are buying used cars, and used car prices have skyrocketed. When you combine this intense demand for goods as opposed to services with pandemic-related supply disruptions, especially in East Asia, where we import goods from, we just have, in spite of higher production, an overwhelming problem of supply chains that are just not up to meeting the demand that there is for goods. We have the ports of Los Angeles and Long Beach, other US ports like Savannah, that have container ships that are just lined up for weeks trying to offload their cargo. The pandemic's also had an effect, and you alluded to this, on labor supply. So now the unemployment rate is down to 4.6%, which is a big accomplishment. We have a strong labor market, but labor force participation in the United States has declined. And in spite of the fact that vaccinations have increased and the economy is doing well, people are not, as you said, they're not coming back into the labor force. It's unclear why. My own best guess is that people who work in jobs involving a lot of face-to-face contact still have issues around exposing themselves to the virus. And so you see, especially in service sector jobs and in education and childcare, people not coming back into the jobs that they had. And so we have labor shortages. And that's, as you said, it's beginning to put upward pressure on wages. You know, I believe if we could get back to a more normal economy where people were spending more on services, they felt more confident about being able to work without worrying about childcare and about exposure to disease. Those things would help to alleviate these pressures. We're certainly seeing supply responses, but they can take a while to come into place. I can tell you that the White House is totally focused on supply chain problems, is doing absolutely everything that we can constructively think of to do to coordinate private sector activity to mitigate the problems. And so
I was just going to, because that was my next question. I mean, you have put a lot of concepts on the table, so I want to unpack them a little bit. And just on what you were just saying, there has been a lot of communication about these efforts, right, to ease, let's say, the kinks in the supply chain. For example, to reduce gas prices by tapping the Strategic Petroleum Reserve. So what other steps can the administration do here that will have a big impact on the pace of inflation? For example, would lifting some of the Trump-era tariffs on consumer goods from China, would that help in reducing inflationary pressures? Can you tell us a little bit about your thoughts?
Sure. So, I mean, we should be realistic about what can be accomplished here. This is mainly private sector arrangements. We have been sitting at the table trying to bring together private sector participants, identify where arrangements aren't serving the public interest and where maybe some steps that we can take to work with private sector participants can be helpful. But I don't want to overpromise on this front of what can we do. But for example, Part of the problem we realized with the ports is that they're not open 24/7. Firms that ordered containers were leaving these containers on the docks, using the docks in effect as a kind of extra warehouse. They're short of warehouse facilities themselves. We worked with some of the biggest retailers and with the port managers to keep the docks open at Los Angeles and Long Beach 24/7. Those shipyards started imposing fines of $100 a container a day for containers that are left for more than, I believe it was 9 days, creating a financial incentive for firms to remove these containers more quickly, which would reduce congestion and create room for the ships that weren't able to dock to offload their containers. And this has worked. The number of containers that are sitting there has been reduced by more than a third. The delays in docking have also been reduced. So, there are measures that we can take. We, have talked with semiconductor manufacturers. We're seeing increased investments in the United States. Congress is considering legislation that would support semiconductors, but it does take a long time to ramp up domestic production. You mentioned tariffs. It's not a game changer, but I think the tariffs do contribute to higher prices in the United States. And the Trump tariffs that were put in place, some of them create problems without having any real strategic justification. Our U.S. Trade Representative, Catherine Tai, has been working with the Chinese, reviewing the phase 1 trade agreement, and she's opened up a process in which firms can apply. It's called our domestic tariff exclusion process. In cases where the cost to Americans exceed any benefits of the tariffs, this is a process by which tariffs can be lowered. And I think that could be helpful. Again, it's not a game changer, but these are things we're doing to try to mitigate these pressures.
Now, of course, you mentioned, as everybody's talking about this week, Omicron. How big is a threat? How big is Omicron a threat to the global economic recovery?
So, it really depends. I think we're very uncertain at this point just how significant a threat it's going to be, and closely, watching the scientific evidence on this that's accumulating. But hopefully it's not something that's going to slow economic growth significantly. But, the Delta variant did unexpectedly prove this fall to really cause some problems. We saw a severe slowdown in economic growth in the United States on account of it. As Chair Powell testified, we testified for the last 2 days together. As he mentioned, this could again exacerbate supply chain and inflation problems. It could depress demand and cause slower growth, which would impact inflation the other way. There's a lot of uncertainty, but it could cause significant problems. We still evaluating that.
Now, of course, you mentioned Chair Powell, and Chair Powell has indicated himself a wind down of stimulus. Are you concerned about the effects of a possible rate rise in the first half of the year on the economy?
So I'm not going to comment on monetary policy. I one of the strongest defenders um, of the independence of the Federal Reserve. It's up to him to decide what's appropriate. But when you see how strong economic growth is in the United States and how tight the labor market is, he's indicated, and I certainly understand the reasoning here, when you're buying assets, as the Fed continues to do, that's really adding accommodation in a situation where inflation is a concern. And, you know, surprisingly, we haven't seen labor force participation rise. So it makes sense. You know, when it's appropriate to raise rates, it's up to the Fed to decide, to watch how things evolve. They'll be carefully, they have a very strong commitment to full employment, to wanting to see a strong economy. I know that they will be devoted to that goal, but they also have an important role to play in making sure, I mean, that the inflation pressures, they reflect these supply factors. The Fed can't really do anything about that. But what we don't want to have develop is a wage price spiral in which inflation becomes its own self-reinforcing kind of phenomenon that would become chronic in the US economy, something endemic. And it is their job to make sure that we don't experience that again, the kind of thing we had in the 1970s.
Of course, you mentioned the US economy. What about a possible spillover effect on emerging markets of a rate rise?
Well, emerging markets are always concerned about unanticipated rate increases. This is something that I was very sensitive to. When I was Fed chair, I started a cycle of rate increases, and they had gone through the episode in 2013. We was dubbed the taper tantrum, when markets began to fear that the Fed was going to start raising rates. What happened is that US rates rose abruptly and by a lot, and that tended to attract capital away from emerging markets and toward higher yields in the United States. It put upward pressure on the dollar and downward pressure on their currencies, causing them considerable problems. You know, I promised myself at that time to communicate as carefully as I could to avoid surprises that could have adverse impacts. And I think the Chair Powell has indicated his commitment also to communicate very clearly in advance about what the Fed's policies will be. But I would say that a strong US economy and strong growth in the US, which is what would likely prompt rate increases, is something that is generally good for the world and for emerging markets.
You've given us good context for what is happening today. What would you say are the biggest risks right now to financial stability?
To financial stability.
To financial stability.
Well, you know, we went through a very significant episode of financial instability at the onset of the crisis. And if you look at some of the things that happened then, I think you see what some of the risks are to financial stability that linger in the US and in the global economy. So, I mean, one of the things we saw at the beginning of the pandemic, I'm going back here to March of 2020, is that the banks did extremely well. They could have experienced losses, seen runs, been under pressure. But I think what we saw was that the reforms put in place, the Basel Capital Accord, and all the work that was done to strengthen particularly systemically important financial institutions, but banks more generally. They worked, and the banks have done extremely well. So from a financial stability risk point of view, I feel very good about what's been accomplished with the core banking system. But the Fed had to do massive interventions in financial markets to maintain financial stability. And the real risks appeared outside the core banking system. So money market funds experienced runs. This was a repeat of what we saw in the financial crisis in 2008. Some reforms were put in place in the United States, but they were clearly not sufficient. And we knew at the time they were unlikely to be sufficient. And we just had a test, and the money market system failed the test. So they remain run-proof, and I think are a risk, and further regulations need to be put in place there. We saw massive withdrawals from open-end bond funds that could have provoked enormous problems of funds that have promised daily liquidity, open-end bond funds that hold assets that are at a minimum less liquid than their liabilities. And we could have had a fire sale of bonds that would have pushed up interest rates for companies and really threatened financial stability. The Fed intervened with facilities that calmed markets and prevented that. But I would see corporate bond funds, open liquidity problems at these funds as remaining on the to-do list. The Treasury market, which is the biggest and most deepest, most liquid financial market in the world, experienced extreme stresses. In March of 2020, the Fed intervened massively over a period of, I believe it was about 6 weeks. They bought more than $2 trillion worth of securities. So the Treasury market did not function well. And we have an interagency working group that is looking at why it is that intermediation didn't expand to fill the need that was clearly there at that time. And we need to do reforms to the Treasury market to improve the availability of data and visibility and boost intermediation in that market. There was much discussion at the time of hedge funds and the role that they may have played in the problems in the Treasury market. So I chair FSOC, the Financial Stability Oversight Council in the United States, and many of these issues are in our agenda. Then, of course, there's climate change, which is a separate topic, but also a financial stability risk.
I'm going to come back to actually some of the regulatory points you just made, but just very quickly, because some of the questions that are coming in address this as well.
Sure.
What signs would there be if the US economy were actually overheating? What signs would you be looking for?
Well, certainly we would be looking at price and wage behavior. And, you know, indicators we have now suggest a very tight labor market. So overheating usually means tight labor market. And I said, well, there are forces that I believe to be pandemic related that have diminished the supply of labor, that have cut labor force participation. I have expected labor supply to increase as we got the pandemic under control. I can't say that I see that at this point, but we've got a tight labor market. The quit rate, which is one of the most cyclically sensitive indicators I've watched for years, it's reached its highest ever level since the beginning of this series, I think in 1981. And we have a tight labor market, upward pressure on wages, which is to some extent good, but can also induce further price increases and needs to be watched.
Let me just move you to the global stage now. You have worked very hard with finance ministers from around the world to win support for your global minimum tax. What are the prospects for getting the necessary congressional approval? And in particular, if there are problems with approval of the administration's Build Back Better package, what is the plan B to deliver what you have promised allies?
So I don't have a plan B to suggest at this point. The changes that we need to put in effect in the United States are contained in the Build Back Better package. And if it's passed, the United States will come into compliance. The increases in our own, so it raises our own global minimum tax to 15% and moves it from a blended to a country by country basis. And it does so at the beginning of 2023. So it's not immediate, it's deferred. And that is the time horizon that other countries who are part of this agreement have agreed that they will phase in the same changes.
Let me ask you about China, because you mentioned it. You know, China clearly looms large in US foreign policy at the moment, and your predecessor certainly played a key role. Are you planning to take a more forceful role in this bilateral engagement? And I say this especially in the wake of China's regulatory crackdown on sectors like technology and real estate, which could have a destabilizing effect, not only on the world's largest economy, but beyond. For example, are you planning a trip to Beijing anytime soon?
Well, you know, Beijing has had very tough restrictions in place with respect to visits by foreigners. A few US government officials have gone to China, but been very restricted in what they can do there. And I believe it's the case that President Xi and most of the senior Chinese officials have not traveled internationally. So while I'm certainly open to that, that's not on my agenda. But I have initiated a dialogue with my counterpart in China, Leo He, my colleague, Catherine Tai, our trade representative, is discussing trade issues, which is her domain, with Chinese officials as well. But there are a whole range of issues, technology practices, securities markets, exchange rate practices, the rebalancing that's been taking place or at least planned in China that I think could make a big contribution to mitigating global imbalances. These are all topics that we've been discussing, and I expect those dialogues to continue.
Okay. I have a couple more questions for you. One is, you mentioned regulation. There are a number of important regulatory roles open at the moment, but let me ask you about one. When do you expect the president to fill out the Federal Reserve Board's vice chair of supervision? Have you made your recommendation on this role?
Well, it's something we're working with him on, and he indicated his intention to make these nominations pretty quickly. I don't have an exact date for you, but I expect them to occur pretty soon.
What job is harder, Fed chair or Treasury secretary?
Well, they're both very important jobs. I would say that the Fed's responsibilities are somewhat more focused and a little bit narrower than those at Treasury. I'm still on the learning curve, I have to admit, about Treasury's responsibilities, but frankly, they're vast. And it's a challenging position. We for example, have responsibility for implementation at Treasury of almost $1 trillion worth of programs under the American Rescue Plan, $350 billion that's going to state, local, and tribal governments, emergency rental assistance, housing, support for airlines and other things. And we take the administration of these programs. We want to make sure that the support that Congress has voted really translates into meaningful changes in the lives of Americans, and that the money is distributed efficiently and fairly. So that's an area. Sanctions are an important issue. There are tax policy and international responsibilities as well as domestic.
So with all of this, do you expect to serve more than 2 years in this job?
I have just started going. I have no plans to leave this job. I'm enjoying it very much, and we've got a huge amount of important work to do. So I have no plan to leave Treasury anytime soon.
Great. And now this would have been the last question, but our audience is gaga about crypto. So I have to ask you one other last question, which is partly from all the questions in the audience. The administration's nominee for Fed Vice Chair, Lael Brainard, has looked favorably on central bank digital currencies. Would you like to see the Fed pursue one? And will you give the Fed explicit backing for that?
So the Fed has promised to produce a report on its evaluation of a central bank digital currency. We're waiting for that to appear, and Chair Powell has promised that it will be very soon. I see both pros and cons to doing it. And my own mind is not made up about this. I think it's important to understand what the Fed's view is. They agree this is a decision that is one where we need to have consensus. They will want to know what the administration's view is on this. And frankly, we haven't discussed this yet in a serious way in the White House. And Congress is going to weigh in on this too. This is a decision that's important and needs to command consensus. There are some benefits, but there are also meaningful costs. And so I just, it can work to disintermediate the banking system. We need to work through the pros and cons. I don't have a view yet.
Okay. And just to close then, it's been nearly a year since you've been in charge of the US economy. And there are, in fact, many more women in charge of the US economy right now on the Economic Council and the US Congress writing legislation. What has the difference been? Has putting women in charge made a difference in the way the US or the global economy is run?
Well, I do believe that diversity is very important. And I often appeared when I was Fed chair in events with Christine Lagarde. And Christine Lagarde often commented that if it had been Lehman Sisters instead of Lehman Brothers, we might not have had a financial crisis. And that's something that always sticks with me. I think women do bring to the table a kind of proclivities with respect to managing risks and weighing costs and benefits that may lead to more judicious and cautious policies sometimes. And look, I think what research shows is having a diversity of people at the table generally results in a wider range of factors being considered and weighed, and better policy making at the end of the day. So diversity is a very important goal for the Biden administration and for Treasury.
Thank you. Secretary Yellen, thank you very much for being with us today. And I hope that the next time will be in person.
I look forward to that. Thank you, Alessandra.
Thank you.
Be with you.